India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Thursday morning coming out of a holiday, midweek market holiday. And of course, winding down the week with today, Thursday, and then of course, tomorrow, Friday as well. Lots and lots of stuff to talk about, both local and global. You're with us, of course, here over the next 2.5 hours. We'll do that. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues, Nigel and Surabhi. Guys, hi, good morning.
Hi, good morning, Prashant. Good morning, Nigel. That small holiday, I mean, there was so much news flow coming in. It didn't feel like a holiday, but nonetheless, we're happy that that it happened. And let's start by wishing all our viewers a very, very happy Navratri. The festive season kicks off, and today is day one. So to your families, to your loved ones, to all of our viewers, wish you a joyous festive season. But, you know, folks, the news was anything but joyous out of the Middle East, that escalation, the barrage of rockets being fired. Frankly, I thought markets, I mean, I dare say, seem a little complacent because the reactions, this is Iran we're talking about. This is not another Hezbollah or whatever. Yeah. I mean, the images coming through, and right now there's an eerie wait and watch going on. The whole world is waiting to see what is Israel's retaliation, what form does it take. Does it target the oil infrastructure or not? But beyond oil infrastructure, beyond markets, I'm just hoping this kind of de-escalates. Because the last couple of months have been pretty difficult.
Yeah, that's right. Just for the good of mankind, you know, step aside or in terms of markets, etc. You just want these sort of instances not to take place. So just for the good of mankind, I think there should be some kind of de-escalation. And hopefully that comes about. On a positive side, Saudi as well as UAE, they are on the sidelines for now. So that at least helps the oil market in terms of those supplies and those dynamics.
Well, absolutely. So let's take it straight to, you know, where we are this morning as we begin this almost looks like a sort of a fresh episode, right? Although we've been trading all through with just a holiday yesterday. So from last night, there had been no sort of reported retaliatory attack by Israel. So that's essentially point number one. Remember, you know, you would have, it's very, very hard to miss. Iran, of course, launched missile strikes on Israel, no reported casualties, etc. But that was Tuesday, you know, post-market, Tuesday for the US, and of course for us it was Tuesday evening as well. Now, the Iranian president has vowed a stronger response if Israel retaliates. So, you know, they're already awaiting a response, and it's about when. This is essentially Israeli officials. This is all sourced, and there are lots of reports doing the rounds. But this one specifically I want to put out to the political news website called Axios. And they said, this is Israeli officials to Axios, and they're saying that will launch a significant retaliation within days that could target oil production facilities inside Iran. You know, so far, you know, this back and forth between Israel and Iran has had elements of almost coordination. You know, we launched 2 missiles, and, you know, you got a safe face, and you will do something, but eventually it kind of goes off ramp in a diplomatic way, and it does not escalate. But over the last 24 hours, this seems a little different in that sense. So, you know, that's where we are at, awaiting what happens in this chapter. Now, a bit of stability in US markets, and the VIX cooled off a little bit, 1.25, but the big jump, of course, came on Tuesday as all this happened. VIX went up about 15% odd. US equities were flat. I mean, the NASDAQ was nothing, unchanged, but the big, again, change happened on you know, the cut that the 1.5% cut that we saw on NASDAQ on Tuesday. Oil prices, well, what's happened over the last 2 days? They're up 5% since we closed, right? We were at about 71. We are at about 75 on Brent oil prices. So that's a big jump that you're reacting to as you come back this morning. U.S. Treasuries, they've had a complete round trip. You know, they fell 5 basis points on Tuesday. Last night, they went up 5 basis points. It's largely unchanged as we look at things. Dollar is also stronger. Dollar index, I mean, there is, of course, you know, money goes home, it says, and that's US dollar, and that's up about 1%. Over the last 3 sessions, we're back at about 105.5. So that's essentially the what's happened and not happened in the what we're awaiting to happen in the Middle East and the market reaction so far. In Asia, Japan, the Japanese currency has been the big mover. And I just want to put this up. The new Japanese Prime Minister made this comment yesterday. He said that we are not in an environment now to raise rates again. And that caused a big move on the JPY. We were at 145 yesterday, this morning at about 146.6. So it's the JPY has been the global underperformer. There is, of course, elements of the dollar strength as well, which is playing out. But 146.4 on the USD JPY is where that particular currency is at right now. Now, in macro data out of the US, the jobs data is the big one. That's only tomorrow, right before markets open. So we'll wait and watch for that one as well. There is a fair bit in India which we need to tackle, and we will get to in just a bit. The SEBI F&O rules and some of the consumer companies which have disappointed. It's a bit of a subdued kind of picture as we begin the day, both local and global. So watch out for supports. The 20-day moving average at 25,500 is the important downside level for the Nifty. For the Bank Nifty, that number, the 20-day moving average, stands at 52,538. And below the 20-day, for the Nifty Bank specifically, the 40-day exponential comes into focus, which is 52,150 or so. I think risk sentiment stays muted, not just here, but globally as well over the next couple of days as we await, more than anything else, what happens out in the global markets, especially because of what's happening in Middle East. And it's not as if there is something happening locally which is very, very positive. As I said, SEBI norms, earnings, the previews which are coming through, they don't paint a very, very healthy picture. Nigel.
Well, that's right? The GIFT Nifty is suggesting that we open up with a cut of around 100 points, and the bulls, they have their hands full because plenty of headwinds is what is faced in today's trading session just at the start. Middle East tensions, that's the reason that crude oil prices have moved up, and the dollar as well is at the highest level you've seen in 3 weeks. So that's not very, very favorable. SEBI, they have attempted to curb speculative trading, and those measures will come into play in the next couple of months or so. And the third factor is just in 2 sessions, the FIs have sold closer to $2 billion or thereabouts. In Tuesday's trading session, it was 5,000 crores. The previous session was closer around 10,000 crores. So those are the headwinds up in front of us. What about positioning? The FIs, they continue to remain net long, though the long positioning has come down a little bit in the last few sessions, close around 40,000 contracts lower. The clients, they continue to remain net short, but they have cut their positions. You have seen this 300-400 point fall in the Nifty from the recent peak. Well, and they've been covering their shorts as well, which normally indicates that they're not too confident that the markets are going to drift a little bit lower. So today's dip, we'll have to see whether or not that gets bought into. Options data, you have the Nifty expiry that plays out today. And between the 25,800 call, 25,900 call, between them, more than 60 lakh shares getting added out there. So the bears are getting confident that we won't get past this 26,000 odd mark, which explains why the PCR is now closer around 0.83 odd. A few sessions ago, it was at around 1.2. What are the levels you're tracking then? The important levels, the near-term technical support levels on the Nifty as well as the Nifty Bank, they're up for you on the screen, which is at the 20 DMA. So for an adventurous trader, you get a 100-point downtick today. You'll keep this as your stop loss and you'll hope that the Nifty bounces out there. Otherwise, it limits your losses to around the 20 DMA. So we'll have to see how that plays out there. The big boy is Reliance Industries. That's been actually a relative underperformer. In the last 6 months, the stock has been unmoved. The Nifty is up 15% in this period. And now it's trading below the 20 as well as the 50 DMA. So it'll be important for Reliance Industries to find its way back towards the 2,960, 2,970 odd mark, because that's a bit of a resistance zone. The other one we're looking at is a stock that's come out of the F&O ban. So we'll have to keep an eye out because the technical factor sometimes does play out. But Balrampur Chini is a stock we're tracking. So a downtick to kickstart trade, an adventurous trader may be looking at buying this dip and keeping the 20 DMA as the crucial support zone.
All right, Nigel, thanks very much for that. Well, let's run you through some calls which are coming through. This is Christopher Wood of Jefferies who's coming in with a quick view. He says that end of the quarter and following one of the most violent counter-trend rallies in China, greed and fear is ever seen. Some adjustments will be made in the Asia-Pacific ex-Japan relative return portfolio. He says the weighting in China will be raised by 2 percentage points to maintain the marginal underweight position in that market. And India, so it'll be essentially paid for by reducing India by 1 percentage point.
All right, so a bit of a tactical change by someone who's a long-time India bull. That's been the ferocity of the Chinese pullback. Well, let's discuss all of these developments. Pooja Sriram, U.S. economist at Barclays, is with us. Pooja, good to have you on, and morning to you. Thanks for taking the call. So let's start by looking at the market's reaction and interpretation of the events in the Middle East. Of course, Tuesday was a day of volatility, but the market seems fairly sanguine. For some reason, it seems to believe that this will be contained. What is your sort of thought on what we're seeing right now, the uncertainties, and just the way risk assets are poised, equities? Oil saw a mild pullback, but in general, I mean, markets were not too unnerved.
Yeah, hi, and good morning to all of you. Yes, it's been interesting. We're clearly following the developments quite closely. For now, like you said, the sentiment still surprisingly seems to be fairly risk on globally. It does seem like there's a sense that this might remain contained, that it's unlikely to get out of hand, just given that it could have pretty large repercussions should it become, an all-out war. And just to sort of comment on the risk-on sentiment, since I'm sitting here in the U.S. and I cover the economy here, the sense that we're getting here is, the U.S. growth, story still looks pretty good. We're seeing, an easing in monetary policy, which the Fed kickstarted with a very strong move. And then we've, also seen a broad monetary policy easing by other central banks in the developed, as well as some developing economies. So against that backdrop, I think there's some sort of an offset to what's happening in the Middle East.
Okay. Hi, Pooja. Good morning and good to see you in. What are you factoring in terms of Fed action, though, from here on? If you could tell us how you're factoring in another 50 basis points for the remainder of this year. And also, I wanted your comment on crude oil prices. For now, the UAE as well as Saudi Arabia, they're sitting on the sidelines. And if needed, they could ramp up production as well. So I guess that's one of the factors that's weighing on crude oil prices. What's the range you're working on? Comment on both Fed as well as on crude oil.
Sure. So I'll start with the Fed call first. Our baseline is 2 more 25 basis points cuts this year. So one in November, one in December. And that's exactly what the FOMC had penciled into their projections as well. And, the rationale there is, there is the data in the US, particularly on growth, on consumer spending, still looking quite healthy, which suggests that there is, a fair bit of momentum left in the economy. Of course, the one pocket of concern remains the US labor markets, which is why the data that comes out on Friday will be critical to how things proceed. But our base case is, even the labor markets seem to be cooling in a very gradual, disciplined manner. And we think, 225 basis points is likely to be the way forward, unless the data tells us otherwise. And just coming to your second question about crude oil prices, it's, surprisingly, they haven't reacted as much as one would have expected. And, there is definitely a bit of that supply boost that we're talking about, which is possible. Our own sense is that, we could see a scenario where it, goes up to about $85, $90 a barrel by the end of the year, should these should the war sort of continue and exacerbate. But there are likely to be offsets from the inventory situation as well.
Okay, so as of now, Pooja, to sum things up, you are still going in for, the expectation of a soft landing in the US and a resilient economy and positive markets, right?
Yes, that is right.
With the caveat being, if you could just repeat the level on oil.
We're about 85 to 90 by the end of the year.
85 to 90. So that still gives plenty of cushion and comfort from where oil prices are right now, even if there is an unfortunate flare-up in the Middle East. Thank you, Pooja, very much for joining in. Good to get that perspective. So that's a view from Barclays on, of course, how the U.S. economy is poised right now and what potential the flare-up in the Middle East, what potentially that could do to oil prices. Well, let's quickly move on and talk about all the corporate interactions that are lined up on the show today. Coming up at 8:35, we have Pralay Modal, MD and CEO at CSB Bank, joining in to decode the impact of RBI guidelines on gold financiers. At 9 a.m., we will be joined by Rajesh Baheti of Crossseas Capital Services to discuss the latest SEBI announcements and changes for the F&O segment and how this could impact market participants. At 9:20, Yogesh Patil, CIO Equity LIC Mutual Fund, talks about the market perspective from here on.
Okay, well, at 9:30 this morning, we'll have the management of NLC India who will be with us to discuss the new electricity plan and also outlook for FY25. A little later at 9:50, Ben Powell of BlackRock Investment Institute will join in to discuss the outlook for markets going forward amid rising geopolitical tensions. And of course, on It's the Economy, Lata will get chatting with Harry Murphy of Credit Suisse. Will get chatting with Moody's Analytics, Louis Kui at S&P Global Ratings, and Jeremy Zook at Fitch Ratings. Those conversations come up at 10:15.
Well, time to slip into a short break. On the other side, we'll focus on all the top stocks we're tracking for you.
Welcome back. You're with us on Bazaar Morning Call. Well, we're dealing with multiple cues, and all of it put together is implying a little bit of caution as we start things off. We'll get the implied open up for you in just a second. There are lots of individual stocks to track as well, and our team is standing by with the CNBC-TV18 list of top stocks to watch. Let's kick it off with Vinny. She's been tracking all the auto sales numbers that were coming in over the midweek holiday. Vinny, Hero, Moto, and a couple of others. Tell us more.
Absolutely. Hero, Moto, Eicher Motors, as well as Maruti Suzuki that came out with their September auto sales numbers. So the two-wheelers, both of them have managed to do well. Eicher Motors also, we're expecting it to open in the green, beating the estimate of CNBC poll. Overall, a 10 to 11% growth in terms of total sales numbers. Exports have seen a very good growth. 77% growth for Royal Enfield is what we're seeing coming in. And number of units sold is around 7,652 in the export market. So that growth momentum continues for Royal Enfield. Even Hero Motor, that is also managed. We are expecting it to open in the green. Good set of numbers in terms of auto sales. Growth of around 25% on a month-on-month basis, 18% growth on a year-on-year basis. Domestic sales, exports, both the momentum on both these fronts have continued. Whether you look at it versus last year or the last month, strong growth there as well. Maruti, on the other hand, we're expecting a bit of a red for this stock today. The estimates and the sales volume, what we're comparing, it's in line with what the street was also anticipating. Not much of a growth in terms of total sales, just around a 2% growth. PV sales have been seeing a decline, so down 3% on a year-on-year basis. LCV exports not exciting there. And lastly, Bharat Forge, we have the NA Class 8 numbers that have come in for the month of September, where we are seeing a very good growth in terms on the month-on-month basis, 124%, and year-on-year basis, a 4% growth. So keeping an eye out on that. September orders have been at a 10-month high, so expecting a bit of a green here.
Got it. All right. Thanks a lot for that, Vinny. Well, let's go across to Mangalam. He's here to tell us about Dabur as well as Marico's business updates. Mangalam, morning.
Good morning. So Dabur will well be the stock on the way down in today's trading session, and that's largely because of a big dampener coming in from them in the second quarter update. Two things. One is that their consolidated revenue will decline in mid-single digit, and as a result of which the EBITDA margins will also decline to mid to high teens versus earlier guided 20%. Why is that? Because of two reasons. One, heavy rains and flooding in parts of the country impacted out-of-home consumption, and as a result of which the beverage category saw a bit of a dip. And secondly, the more important one, due to high growth in quick commerce and e-commerce, the company has decided to rationalize inventory that is there in general trade. And this is an interesting trend that we'll be watching out for, not just from Dabur, but all the other FMCG companies over the next couple of quarters as well. While we've been talking about growth in quick commerce, it's actually now beginning to impact growth in traditional trade as well. So as a result of which, expect the stock to be lower. It is already down 10% from its 52-week high level, but let's see how much further lower does it get today. The other stock we're watching out for is Marico, and this may well be the stock on the way up today. Why is that? Because the consolidated revenue for the company grew in high single digits. Domestic business posted mid-single digit volume growth. And importantly, remember the stock underperformed when Bangladesh had that impact out there. The company said Bangladesh posted high single digit growth in this quarter. So we'll keep an eye out on Marico. See green on Marico and red on Dabur.
Maybe deep red on Dabur. We'll see. Mangalam, thank you very much for that. So that is FMCG in focus, and perhaps we'll watch implications otherwise in that sector as well. Well, Aurobindo Pharma had some negative news flow on Tuesday. Well, it's got some positive news flow this morning as we start. Ekta is here with that. Ekta, morning.
Morning. Well, maybe the stock should probably be in the green on the back of this approval. They've received final approval from the US FDA to manufacture Keflit generic tablets, which is basically an antibiotic. Aurobindo has been granted competitive generic therapy designation for this drug. So that means that they're eligible for 180 days shared exclusivity, expected to be launched in Q3 of FY25. But remember that this news comes in context of regulatory issues which they've been facing in the past couple of months. So maybe, there could be, the upside could be limited on account of it.
Okay, all right, got that. Ekta, thank you very much. Let's move on. Vivek is watching out for JSW Energy. Vivek, morning. What's the news?
Well, good morning. An important development coming in as far as the company's renewable energy ambitions are concerned. The company's renewable energy subsidiary known as JSW Neo has received an LOI, letter of intent, from the Maharashtra State Electricity Department. Now, this particular LOI is for going ahead and supplying 15 megawatt, which is moving up to almost 20,000 megawatt per hour. And this is for providing energy storage capacity for a period of almost 40 years. So again, a long-term commitment coming in from the Maharashtra State Electricity Board. Now, what does this mean for JSW Neo? Number one, the total locked-in storage capacity now stands at 16.2 gigawatt hour, where pumped hydro is almost 14.4 gigawatt hour and battery storage is 1.8 gigawatt. It's a positive development. Expect the stock to be in green today.
Okay, all right. Thanks, Vivek, for that. Well, let's across to Sonal. She's here to tell us about Jubilant Ingrevia. Sonal?
Good morning, Nigel. Well, there's a big order win that has come by for Jubilant Ingrevia, the wholly owned subsidiary. It has entered into an agreement with a global agrochemical company. This is to supply agro intermediate for one of the key agro actives of the customers. And here the consideration is huge. It's around $300 million plus to supply these agro intermediates to the customer. And this will take place once the commencement of production happens over a couple of years. But yes, this is a big amount which would come into the books of the company. The company says subsidiary will be investing in the manufacturing facility. We don't know the quantum of investment. That'll be important to track. And manufactured agro intermediate will be exported from India. It is not for domestic usage but for exports. So we'll have to look out for margins from this product as well.
All right. Thanks very much, Sonal, for that. Well, oil prices are a big headline, and that's a big macro marker. 5% since we last closed at 3:30 on Tuesday and went into that holiday. So almost knocking at 75. Manisha is here with more. Manisha.
Thank you for that, Prashant. Well, yes, the 5% of a knee-jerk reaction, prices have started to gain for a third straight day today as well. Iran on Tuesday fired more than 180 ballistic missiles at Israel. Hostilities seem to be now seeping further into East. And remember that Middle East produces 1/3 of global crude. As of now, we haven't seen any threat to the oil supplies. But if that happens, if that is a retaliation, and Iran being one of the major prominent members of OPEC as well, you could be looking at further premium coming in for the prices. At this point in time, also the prices are contained because the U.S. Crude production continues to increase. The U.S. inventories also surged by 3.9 million in the previous week. And also the U.S. gasoline demand is at the lowest in 6 months. So, and these are just U.S. numbers. The Chinese numbers continue to be on the weaker side as well. OPEC has said that they will increase production from the month of December. The next OPEC meeting is on 1st of December. So the markets really are rising only because of the geopolitical tensions. Because otherwise, when you look at the supply and demand situation, that still continues to be bearish.
Oh, yes, Manisha, we remember you gave us the numbers. I think it was a 9 or 10% decline in September otherwise for oil. But October has started off on a very, very different note. Thank you so much for joining in. We'll track it through the course of the day as well. With that, let's quickly recap our list of top stocks to watch. The ones that have positive news flow are Eicher Motors, Hero MotoCorp, Bharat Forge, Marico, Aurobindo Pharma, JSW Energy, Jubilant Ingrevia. The ones that have negative news flow around them are Maruti Suzuki and Dabur. Crude users, of course, could be negatively impacted as well as prices remain well bid and the uncertainty continues. On that note, let's take a very quick break. On the other side, we will be in conversation with Pralay Mondal, MD and CEO at CSB Bank. We'll talk about, of course, the trends in the second quarter and the impact of the RBI advisory that's talking about a lot of the internal compliances and regulatory issues that need to be carefully monitored. Talk about that and more on the other side. Welcome back. Now, you'd remember the chatter from Monday when the RBI issued an advisory. So, on Monday and Tuesday, there was some pressure on the gold financing stocks because the advisory didn't point out fingers towards anybody, but it did say that there are a lot of internal issues, especially where banking correspondents are involved or third-party service providers are involved, where perhaps proper due diligence is not being done. The RBI raised issues like when gold auctioning happens, whether all the norms are being followed or not, whether the end use of gold loans, whether that's being properly monitored or not. So it in general was advising for more caution and higher due diligence. Well, we have to discuss that and a lot more with our next guest. We have with us Pranav Gundapalli, Senior Analyst, India Financials at Bernstein. Pranav, thank you for taking this call. So let's start right there. What did you make of the advisory? It wasn't penalizing in nature at all for anybody, but it was pointing out to a lot of potential discrepancies which are there in the system, a little unusual. What's your stance on the listed gold financing plays right now?
Right. See, I think it was in line with the series of actions that RBI has been taking on the consumer side. So given that the gold loans have seen a significant increase, was not a big surprise. But I think on the positive side, the lack of any specific changes to the product, credit risk weight or something of that sort, was probably a sign of relief, number one. And number two, given that they had a long list of observations and have left it open for the lenders to go and fix it over the next 3 months, suggests that either A, we have this as a more widespread issue, and two, is something that they would prefer the lenders to solve themselves, not something that can be solved by extra regulations or extra risk weights or interest rate caps and stuff like
that. Got that. So, Pranav, just a quick, should we differentiate between companies which have been in the gold finance business for a long time, like Muthoot and Manappuram, right? And companies and banks who've gotten into the segment because it's such a fast-growing area. Because I remember even at the time when that, the IIFL ban happened and they clarified that you can only disburse so much in cash, right? There were conversations that, companies which only do this or have done this for a long time, I mean, there are set processes and the regulator also kind of understands how this has been happening, etc. But from some of the is this more directed towards some of the newer players who've come in that sense?
Definitely.
Yeah.
In fact, we actually think this set of regulations are positive for those who've been doing this for a long time, like Muthoot or Manappuram. Because if you look at the list of observations, those almost seem like 101 stuff that most of the gold lenders would have solved by now. And they've survived 2 decades of RBI audits. So I'd be very surprised if there is a slip up from the monoline gold lenders on some of these areas, right? And also, given that they don't have the hassle of doing agri gold lending, which is what a lot of banks focus on, I think the whole end purpose monitoring and agri documentation, etc., would also be less onerous on them. So, I see this as like you said, a greater change for banks and also other fintechs or NBFCs that have entered into the segment, especially in the context of a slowdown in unsecured lending. So there is a general shift towards more secured lending. So this is more a preemptive move from RBI to say, let's kind of tighten this before we see a flurry of new players coming.
Okay, all right. Pranav, request you to stay with us. Let's also get in the management of CSB Bank, since we're focusing on the gold financiers, and they have a fair bit of their portfolio as well that's inclined to this part of it. Mr. Mondal, the MD and CEO of the bank, joins us on the show. Hi, Mr. Mondal, good morning, and always good to have you on the show, sir. The RBI has asked lenders, they've raised some queries out there. Could you tell us, what is your analysis of it and what is the feedback you have got?
Good morning, Nigel, and good morning to your viewers. Yes, I think there was a communication from RBI on gold loan business and broad directions. And we have been working it for the last 2 years because one good thing about the supervisory process which we have now, where it's a constant supervision, is we have that opportunity to communicate with RBI and their views constantly. And as you rightly said that we have a larger gold loan portfolio as a proportion, there has been conversations happening which has helped us in doing a lot of the things which is being communicated through this circular. So to that extent, as a bank, we are broadly ready with most of the points. Maybe one or two we have to still work on that, and we have to communicate that compliance to RBI. But we are quite comfortable with the implementation of the circular as it has been advised.
You know, Pralay, morning, Prashant here. We just had Pranav from Bernstein, who tracks this space as well. And I was asking him whether this actually is directed towards some of the newer players. When I say newer, I don't mean, I mean recent entrants into the space over the last couple of years. Because as Pranav was saying, that some of this reads like lending rules 101, right? So this is kind of reiterating how you're supposed to go about doing this. And Pranav was saying that maybe for older lenders, and you're an old lender in this space, in the gold finance space, especially in the state of Kerala, Manappuram, Muthoot, etc. as well. So for some of the existing incumbent older players, this actually may be a little bit of a positive, just because it may be a little negative for others. I don't know how you look at it. Quick thoughts.
Yeah, good morning, Prashant. I have always taken the view that anything which is for the industry, and there is no negative, positive, everybody has to be on the same page. And hence, good long-term players will always find a way to do the business in a compliant manner. So to that extent, I don't look at it as an opportunity or as a threat. I look at it that we have to do the right things. And if you ask me what Pranav just said also, that gold loan is a very touch and feel business. And customers themselves are very comfortable when they walk into a branch and do business. And as lenders, we are also very comfortable because it's just not knowing the customer, knowing the collateral, which is the gold, and understanding that there's a lot of experience and a lot of touch and feel there. So to that extent, I think the kind of a traditional method, going through branches, doing it through the branches, having experienced people doing that business do help. And that is definitely an advantage to us for sure.
Mr. Mondal, hi, good morning, sir. You just said that you are in conversation with RBI, and then sort of you're ensuring all the regulations and the compliances are up to the mark, and there could be one or two areas where sort of you're pulling things up. Could you elaborate a little bit on that? What specifically, for a bank like CSB, what would be the concern where RBI would want you to pay greater attention? Because the advisory that came in was very wide. Right from end use of those loans, which, I mean, that end use is not being monitored, to the way auctions are happening. Just trying to understand what the Reserve Bank's concern would be from the older, more established players like CSB.
So you know, in a touch and feel business like this, where value of the loan is small and hence the number of customers and number of transactions are very high, and where the tenor of the loans are also not very long. So to that extent, there has to be a lot of proper documentation processes. Like policies are all in place for us right now. But what I think RBI wants everybody to do, I think we are a little ahead of the curve in terms of what we have already done. Thankfully, we are ready for most of it. But what we need to do more is checking on the ground that what policies and what we have rolled out is happening in 100% cases or not. And to be fair, it is very difficult to have 100% compliance on everything on the ground when you're dependent on individual people, whoever is doing it. And hence the audit processes has to be a lot more stronger. We have implemented that over the last 1 or 2 years, but we will significantly enhance that part. So I think that's the part where we need to do more audits. Let's say if you're doing 1 audit or 2 audit per branches, we may need to enhance that a little bit. I think those are the areas where we want to do on the documentation and the process part.
Got it. So you need to make sure that the regulation is being followed in letter and spirit, and therefore more scrutiny and audit at the bank level or the NBFC level, as the case might be. Will this mean that there's a bit of a slowdown? I mean, the business is almost 45% of your total business, right? What was the growth that you had in mind for the gold loan portfolio? And as you go about ramping up some of these compliances and the audits, will the growth come down in the near term?
So really, let me put it this way. The growth has not happened really because of any of these issues. Growth has happened because if you look at the price of gold has gone up by anywhere between 25 to 30% in the last 1 year. And hence, if you look at the gold view, people are saying it can touch $30 to $100 also in the long run. I'm not taking a punt on that, but I'm just saying what I'm reading. So to that extent, I think that's the reason why gold business has gone up, and hence tonnage has not gone up that much. It is mostly value, and we are very conscious of that. Given all these perspectives, I think we'll continue to do well as long as our processes and compliance is good. And let me put it this way. We saw it in microfinance also many years back. Once better governance, better compliance comes, in the long run, actually business grows and business doesn't decelerate. Only the players who are following it to the letter and spirit actually takes advantage of that. So to that extent, we are very focused on what we want to do, and I don't see this as a dampener for the business. Of course, if gold prices starts coming down someday, obviously there will be a dampener, but right now this is not a dampener. If at all, this will be an accelerator in the long run for good and compliant institutions, whether it is NBFCs or banks.
All right, Mr. Mondal, so tell us, what are you factoring in? I recall Q1 was disappointing because of strategic reasons and regulatory reasons as well, but Q2, you're bounced back. Now, give and take everything with the current price of gold, what are you factoring in for your overall book as well as for gold for this fiscal? Earlier, I think you were alluding to around 18 to around 20% growth in your book. Now, what is the revised estimate, particularly with gold? As you said, tonnage hasn't gone up, but pricing has gone up.
Yes, Nigel, you're right. So, yes, Q1, we had some tactical, strategic, whatever reasons for a softer quarter. I think we have bounced back. We have continuously focused on the deposit. If you look at our deposit growth is around 25%. We have also got enough borrowings to ensure that our other liability parameters like LCR and SFR and all of that is in control. Our CD ratio is also looking good. Overall, only deposit growth is almost 35%. So I think we have focused a lot on the deposit because we thought there is a risk emerging there from a liquidity perspective. So we have invested into that and growing there. On the asset side, as I said before, that irrespective of what the market does, we will grow 30 to 50% faster than the system. We have done that. Hopefully we have done that because we know our numbers. We have to see the industry numbers. We are around 20% growth on assets, and gold has grown by around 27%. So I think gold is still sort of nose ahead of our overall portfolio growth, but I think our wholesale business will start picking up in the second half of the year, and so will SME. And retail is also growing. So to that extent, I'm pretty confident that we'll grow anything between 30 to 50% of the system faster than the system. And that kind of a projection still I hold.
Okay, and we'll quiz you more on the numbers, margin, outlook, etc. when you join us post your Q2 numbers. But Mr. Mondal, one final question before we let you go. You have admitted in the past, that you all were interested in inorganic growth. One of those assets that we have quizzed you about is Bank of Maharashtra. Is there some more inorganic growth that you're looking at as of now?
As I said before, it's not in I think it's a conversation is not with CSB. So I can't comment on that, but not that anything which we know of, which says that we are looking at a large inorganic growth at this point of time. If one of our investors looks at anything, I will not be able to comment on that. But at this point of time, CSB is purely focused on organic growth. Maybe some portfolio here, portfolio there, we'll always look at depending on the pricing and the valuation. But a larger acquisition, we are not looking at as a bank. So that's the way we are looking at it.
But what if the promoter is looking at another asset? Then it's possible that they'll want to bring both these two assets together?
You have to ask them. I am not privy to that, and they have not.
We'll do that. We'll do that in the next month or so.
We'll ask Fairfax. And thank you very much, Pralay. I appreciate you joining in, and good speaking with you here on CNBC TV18. Thanks very much.
Thank you,
Pranav, thank you for waiting. Just a quick word. So what are your sort of top ideas from your coverage universe, Pranav?
Yeah, so I think amongst the larger banks, we like HDFC and Axis at this point. We are not too bullish on the consumer lenders. We still think that there is some more downside on the asset quality. We are probably a few quarters away from what I would call the bottom of the consumer cycle. So we like the larger banks, and amongst them HDFC and Axis. Amongst the NBFCs, we like the gold loan lenders. We like Muthoot a lot. I think at this point, while there is a tailwind of a rate cut, we would stick with the secured lenders, which is the likes of Muthoot.
So, Pranav, if I could request you for a sneak peek into the season that's about to kickstart. I think one issue that everyone's going to watch out for is credit cost and any deterioration in credit quality with all this conversation around microfinance and unsecured, right? So from that perspective, if you could single out entities that may be worse off. So we need to just watch for those managements, the commentary and the numbers as well. And from the margin perspective, because that's another debate, what's happening to margins considering the rate environment that we're in? What should we watch out for? And which are the entities that could perhaps preserve margins and which are the ones that could see the maximum stress?
Right. See, I think on the asset quality front, it's all the ones with the exposure to microfinance. So the pure play microfinance lenders, you've got quite a few of them that are listed. So they will be the ones to watch out for. In terms of the larger banks, I think microfinance will be an important consideration for the likes of IndusInd, where I think the stock has most of things going for it, except that they need to know where the bottom is in terms of the microfinance credit cost. So that's on the credit cost front. And in terms of the NBFC space, the consumer lenders, SBI cards, Bajaj Finance would be the ones where the credit costs would be the main thing to watch out for. We've seen some deterioration in the last quarter, a prolonged one for SBI cards. A continuation of that would be a negative, especially given the run-up in the last month or so, where there seems to be some assumption of bottoming out of credit costs. If that does not hold true, then we could see significant downside. So consumer lenders on the NBFC front and on the bank side, IndusInd is the one more exposed to the microfinance side. Now, on the margin side, I think we are starting to see some improvement in liquidity, which I think is a positive. So which means that we are probably at the bottom in terms of the margin pressures. Right? So I think this quarter would probably be the one with the last piece of deposit pricing increases. And the ones with fixed rate books will start getting better position as we move into easier liquidity and potentially rate cuts as well. Again, IndusInd stands out there as the one with a greater share of fixed rate book and therefore could benefit from rate cuts. And HDFC, while its loan book is not too different from the others, could see their liability costs move down with rate cuts. So they again will stand to benefit. So amongst the larger banks, with margin pressure almost coming to an end, us looking forward to rate cuts, I think IndusInd and HDFC do stand out as our topics from a margin perspective.
Got it.
Yeah.
Got it. Little short on time, but this is very, very helpful. Pranav, thanks for joining in. And we promise to get you back once the numbers start rolling in. It'll be helpful analysis. You have a good day. Thank you very much for being with us on the call this morning. We'll take a break on that note. Come back on the other side and it's time to talk technicals. What's today's trading setup looking like? Mitesh Thakkar and Sudarshan Sukhani join in with some perspective.
Okay, welcome back. There's 13 minutes to go for the pre-open session. We have Mitesh and Sudarshan with us with what they're making of things and what trades they'd want you to take. Gentlemen, good morning. Good to have both of you here. Mitesh, the GIFT Nifty is indicating a lower start. Will the 20-day, both on the Nifty and the Bank Nifty, be the sort of markers from here as we look ahead? And what's the trade for today?
Good morning, Prashant. So, we were talking about a test of 25,800, which was a support pivot. And on Tuesday, we closed right there. And today we'll open gap down. So that's not a very good sign, though I think the key supports, as you were rightly highlighting, some of the moving averages, they will come closer to about 25,450, 400 zone. So I think that should be the next logical target area. I hope that those levels will hold and we'll get a good bounce back from there. But the structure in the short term is turning negative. So I think, now getting past 26,150 odd levels will be very difficult. Until that is captured, I don't think we'll start a new leg of the up move. And just hoping that this 25,450, 500 zone holds. And then if you can get a bounce back, do some sideways choppy range bound kind of an activity. After that consolidation, there could be a possibility of an up move. So in the short term, I think, reduce your long exposure, look at adding some kind of short exposure on the stock side or on the index via options route. And till 26,150 is crossed, I think, we'll be slightly cautious.
Okay. All right. Got that, Mitesh. Sounding a little bit cautious this morning. Let's get in Sudarshan into the conversation. Good morning, Sudarshan. What's your view in the index? We're bracing, I think, for a sharp decline to kickstart trade. Your view?
Yeah, good morning. My view is that we are in some kind of a correction and we should wait patiently for this decline to come to an end. That sign will come when the market becomes stable, it starts moving sideways it's essentially it stops falling. And that's not just for 1 hour, it has to do that for a couple of days. So that hasn't happened yet. I don't think there is any buy on dips opportunity in either the indices or in most of the stocks. Some stocks will always do outperform. So the focus should be on selected stocks and we should completely avoid the indices.
Okay, got it. Avoid the indices, remain with stock trade. So Darshan, so morning. Let's get to the stock list then. What are you working with today?
Yeah, that's fair enough. See, Deepak, there are a number of buying opportunities. There were a lot of stocks that actually went up on last trading day. So Deepak Nitrates is a buy with stop under 28.46. HAL, which is now moving sideways after a decent correction, is a buying opportunity with a stop under 43.22. I don't have to tell you the context in which defense stocks may outperform. ICICI General Insurance is an intraday short with a stop above 22.92. And Jubilant Foods is an intraday short with a stop above 704. So it's a mix, 2 buys, 2 sells. And position traders can easily focus on the buys.
Okay, got it. Mitesh, what about you?
So I also have a mix of buys and sells, and on the buying side, a couple of fertilizer names. I think that's one sector which is showing strength. So Chambal Fertilizers on a mild decline or a pullback, let's say around 540, 538, buy with a stop at 528. Possibility that the stock could do 560 here, and GNFC is a buy with a stop at 684 for targets of 730. On the selling side is Airtel with a stop at 1720. Look for a corrective decline to about levels of 1640, and Dabur is a sell with a stop at 627 for targets of 595.
Gentlemen, since we have you with us, and I think we'll have Chandan also joining in, Chandan Daparia from Motilal Oswal in just a bit. Before we let you go, just wanted to get your quick 30-second take on the fact that we're moving to a very different F&O regime, tighter norms, higher extreme loss margins, fewer number of expiries per week. Just quick thoughts on whether this hits sentiment or volumes, or what really happens now from the 20th of November. Sudarshan?
Well, I think it'll hit sentiment very badly because stocks options will become untradeable. They'll be valued in lakhs of rupees. So we just see how much of a sentiment hit it will be, but it will be.
And Mitesh, your take?
This is on, sorry?
On the new F&O norms, Mitesh, from the 20th of November, we moved to a new regime, tighter regime.
That's right. So, in fact, to me, it is a good step. I think, you should have some capital before exposing yourself to the derivative segment. And I think that's a decent requirement of, one, increasing the margin requirement and the margin collection norms which have changed. And two, I think, also the increasing the contract size. I think both of them should be actually good and progressive steps. Let's see how it plays out, because that's very difficult for me to comment upon. But to me, it primarily looks like a positive step.
It's a positive step for overall market stability. All right, that's Mitesh's view. Thanks very much, folks. We'll come back to you a little closer towards the market opening. Chandan Daparia, like I said, is also with us for the usual F&O picks. But Chandan, before we talk about the picks, big news. It's finally come through. And I think we'll just put up the graphics as well. A lot of sort of tightening is happening, right? First of all, the number of expiries is going to go down. Then the calendar spread, that's also being taken away. I mean, rules are being tightened over there. There's going to be a monitoring of margins, I think 4 times in a day now. So lots of steps. Your thoughts on what the market impact could be over the next couple of days till the rules get implemented?
Good morning, Surbhi. Thanks for having me. So as per the previous proposal, they came out with the 7 measures for F&O guidelines, and finally most of them implemented, and they also given the dates. But I believe whatever the regulator had decided is good for market or retail participants as a whole. But there are a few points we need to keep in mind. First, that earlier there used to be the everyday as expiry day. We actually entered into the world of everyday as expiry day, but now there will be very selective expiry. Question will be whether there will be Nifty and Sensex. If Bank Nifty weekly expiry doesn't happen, then it will be on monthly. But in NSE, highest business and activities happen in the Bank Nifty. So we need to change the automation and algo product accordingly. And I believe the most of the algos will change their ticket size, drawdown, and modus operandi. Talking about the retail participations, as your contract value increase, so participants has to go in deep OTM strike with the view to lose less. But again, if they enter into the deep OTM, there will be comparative lesser probability to make money in the market. Again, new norms of margin tightening and they have avoid the calendar spread benefits. But I believe as a whole, the market will try to absorb all the guidelines, and slow and steady market will be in a healthy sign. But yes, as of now, slightly negative on the sentiment point of view. But I believe that is good for the Indian market as a whole for long term, because in Indian market, the derivatives turnover has gone 400 times than the cash market. And that is the highest in the entire world. Now, looking at the specific,
Yeah, absolutely, Prashant. Actually, you were tracking this from, I mean, the time it came on Tuesday, right? I don't think the exchanges have come out with anything. I think that's the question he asked. Is it going to be Bank Nifty or Nifty? What will be the weekly product? That's the big question, right?
So first, so there was some confusion because they said that they can choose, but they also said benchmark.
Okay.
So benchmark typically would mean Nifty. And in the case of BSE, it would mean sensex. But they also said choose. So there was some confusion, but we checked. And there is actually, they can choose. I mean, the SEBI does not really, they're saying, well, they can choose Nifty or the bank.
Index.
Either of the two. But there is one view that if they choose, I mean, actually, logically, they should choose Bank Nifty. But because they choose the Nifty, I mean, the BSE BankX is going to eat their lunch. You know, that's but we'll see. The point is, for many, it is the fact that they will sort of stick to Nifty, but the exchange needs to say, as Chandan was also saying. Chandan, quickly your trades and your sort of strategy for today.
Yeah, thanks, Prashant. Nice point you highlighted. So talking about the Nifty index started to form lower top, lower bottom on daily and hourly scale from last 2-3 trading session. It negated the positive stance and seen the negative crossover on most of the mechanical indicator due to the weakness in the global market. So we may open on a negative note until Nifty holds below 26,000 zone. Some more profit booking could be seen towards next key support of 25,500 and 25,333, which is 50% and 68.1% retracement. Now looking at the Bank Nifty, here also we have witnessed some bearish divergence. So some more decline could be seen till it holds below 53,357. Profit booking could be seen towards 52,000 to 51,750 marks. Now looking at the stock specific, first that is buy on HCL Tech. We believe that selective IT counters are likely to do well. Major setup of the counter is positive, and HCL Tech has seen the buying interest. We have seen a better rollout, which also indicate the bullish stance. So with support of 1780, one can look for an upside target towards 1900 in HCL Tech. Second trading idea, that is buy on Chambal Fertilizer. The stock has been making high tops, high bottom from last 6-7 trading session. It has surpassed a falling supply trend line and holding the current zone after a long consolidative move of previous couple of months. So one can buy with support of 540 for an upside target towards 570 level. Last trading idea, that is sell on PNB. We have negative view on most of the PSU name, and this is one of the weakest structure in the market. PNB has been making lower top, lower bottom on the weekly scale. So weakness could continue with stop loss of 109. One can sell for a downside target towards 100 level in PNB.
Okay. All right, Chandan, thanks very much for that. We'll take a very quick break. On that note, come back and we'll have the pre-opening rates as well as more guests on the other side. Welcome back. Well, we'll start getting the pre-open rates. Let's wait for them to settle a little bit. That's the implied open, 200 points on the lower side. And the first of the rates are kicking in. I mean, it's a 300-point dip, but let's just see how this plays out because the market's dealing with a lot. The F&O norms coming through, all the action on the holiday that we missed as well. So let's wait for it to settle. Right now, it's looking like a massive cut. Let's revisit this maybe after 5 to 7 minutes. Prakash Diwan is with us. Prakash, morning. Lots to discuss today. Let's start with Dabur, actually, because, you know, we are all cheering the rural recovery. But here comes Dabur with a not very inspiring sort of update for the second quarter. They're saying sales might fall in mid-single digits. Your view?
Good morning, Surbhi. So I think this is quite in line with what one of the brokerages had brought out a week back, I guess. Remember, we spoke about whether there's enough juice in Dabur left because the juices category being under stress. And that's where, the beverage category is where the management has indicated there could be softness. But, the beauty about these multi-products segment FMCG plays, and especially multi-geography, multi-segments in terms of rural and urban, is that something or the other will give way, but something or the other will actually take its place in terms of growth. So I think if there is a softness because of this, and remember, this doesn't contribute more than just barely to double digits. So it's something which could be an opportunity to load up these names. Festival season is the best time. We've had a very good monsoon all around. I don't see any reason. Input prices are fairly benign. These are opportunities to actually build a little bit of allocation towards FMCG, especially the larger ones. And when I say larger ones, it's beyond the ITCs of the world. Whether it's Manico, whether it's Dabur, whether it's Godrej. So I think it will be an opportunity to buy because of the softness. But there could possibly be some softness given the overall market condition.
Okay, all right. Hi, Prakash. Good morning. Good to see you in as always. Well, we've got a couple of steel notes that came in today. Morgan Stanley has gone ahead. They've upgraded their estimates. The pricing estimates, they believe that spreads will improve, and also they are working with domestic pricing now at par with imported steel. So they like the steel sector, and that's why they've upgraded, and they believe it's well placed. Nomura as well has initiated coverage on two stocks, JSPL as well as JSW Steel, and they've given elevated target prices. Your view on the steel stocks?
So, good morning, Nigel. Very positive. This is on the back of non-ferrous doing well as well. Remember, the rally was kind of led by copper and aluminium and zinc, of course. But steel is now kind of coming into the party. The interesting part is, if you look at data for the first half of FY25, which has just started coming out, cap goods has continued to see a lot of expansion. The kind of spending that's happening in trillions out there means that it's not something which gets over in 6 months or 3 months. You will see that follow-up happen, follow-through happen. And as we go into these 2 quarters, which are probably better than the first 2, you'll probably see steel consumption rise phenomenally. So I'm sure that the domestic demand is there to back you up, very good headwinds from there. And the tailwinds in terms of price rationalization, given the Chinese dynamics, is also kind of going to help them. Whether you would buy an OEM or an derivative is a question. I would still believe HEG from the graphite pack is kind of looking up very smartly in terms of inventory build-up, in terms of demand. I think you'll probably get a little bit of a surprise move from there. And for the simple reason that the global setup also, everybody is wanting to demand graphite rods. So it's not something that only India is doing it, and HEG will kind of be very well poised to balance that. So I would look at something like that, but stick to non-ferrous as well. Don't ignore that, the Dalcos and Nalcos of the world. There's lots of juice left there.
Dabur, you started with juice and juice. Prakash, hi, morning. Just a quick word on, look at the market, by the way, 400-point cut, which means that right at the word go, we'll be starting below the 20-day moving average for the Nifty. So that's the Nifty. Let's look at the Nifty Bank as well. The 20-day here is 52,538. Okay, I think
we still need some time.
We have
3 minutes more.
3 minutes more, so we'll have something coming up there as well. Just look at BSC, the stock. In the pre-open session, and maybe we could look at names like Angel One, which is of course the most traded name. BSC, nothing. I mean, 1.5% lower on BSC. Angel is down about 2.7, and the others are Motilal Oswal and IIFL Securities and MK and a few other sort of names as well. So that's the other pack to really watch out for. Prakash, any specific thoughts on BSC? I mean, lots of debate. I was reading a note from Jefferies. They say, well, they cut their earnings estimate for BSC. There are others who believe that, this would turn volumes towards BSC, and it's a big one, in a positive way. What SEBI has done in terms of having one weekly option, a weekly contract per exchange. What's your sense, BSC?
Yeah, so good morning, Prashant. So on the surface, BSC doesn't seem to be in a spot to lose much. Yeah. It's NSE that would be worried. And as the F&O segment activity starts phasing out a lot of the smaller players, there could be a propensity to move to micro caps, which are predominantly listed on the BSE. But I'm not saying, those penny stocks that people like to do and start kind of having wishful, trades on. It's not something which will last long. Can I build that into the BSE revenue model? The answer is not really. So what's going to help the BSE is general organic growth of demat accounts, of activity, the kind of IPOs that are coming, Prashant. I mean, I think BSE, we don't realize, but BSE benefits equally whenever, there's new paper that comes into the market. And some of these exchange fees structures are such that the more activity in the IPO market has an accelerated return profile. So I would believe there will be growth. Now, whether at 3,800, 4,000, is it worth buying into it from a valuation perspective is the key question. I would believe a softer valuation will give you better risk reward. And the market is in such a condition that state that it is vulnerable to corrections. So if there is a correction, you will probably see 10, 15% come off very easily. So build it for the long term into your portfolio, but I'll be at a lower level so that at least you can be comfortable holding it for a slightly longer term.
So your shopping list is ready, and BSE is one of the names perhaps on it. It's a question of when to go shopping, right, when that correction comes. Prakash, stay on. In fact, let's bring in Vamakshi because she's detailing out all the changes that have happened and, of course, what the view is on the street. What are brokerages making of this? What will be the impact on listed stocks like BSE? Vamakshi, fill us in.
Well, absolutely. The first measure that has been announced is limiting weekly expiries to one benchmark per exchange. Now, this is expected to have the highest impact among all the measures, but the impact is expected to be relatively higher for NSE given that it has 4 weekly expiries as compared to 2 expiries for BSE. IIFL Securities has quantified the impact. They expect a 35 to 40% impact on NSE option premium turnover as compared to 15 to 20% in case of BSE. Earnings impact, however, is expected to be lower on account of shift to the flat tariff structure. They are estimating a 15 to 20% hit on NSE FY26 EPS and 5 to 7% for BSE. The other measure that they've announced is increase in minimum contract size for index derivatives to 15 to 20 lakh rupees from 5 to 10 lakh. This hike is lower as compared to what was proposed in the discussion paper. The third measure is additional extreme loss margin ELM of almost 2% on short options contract on expiry. Keep in mind that 8% was proposed in the discussion paper. So again, this is lower than what was proposed earlier. The other 3 measures could have a larger impact on institutional players, and this includes upfront collection of option premium as well as removal of calendar spread treatment on expiry day, and both of these measures will be implemented from February 1st, 2025. And the last measure that they've announced is intraday monitoring of position limits for index derivatives, and this will be implemented on April 1st, 2025. We have a note coming in from Jefferies which highlights the impact on market players. They expect the impact to be divergent. Retail-focused discount brokers, which includes the likes of Zerodha, Angel One, 5 Paisa Capital, are likely to be most impacted, followed by exchanges, which includes NSE and BSE. The impact for traditional brokers, however, is expected to be relatively lower, which includes IIFL Securities, ICICI Securities, and several others. AMC's wealth managers and depositories, however, will remain largely unaffected in Jefferies' opinions. Overall, Kotak believes that the regulatory overhang is now behind us. There are no fresh negatives, and therefore the market may look at it positively.
Okay, pretty comprehensive and quick. Vamakshi, thank you very much for that. Rajesh Baheti is with us now as well of Crosseys Capital. Rajesh, 6 minutes, 5 minutes to open, market open, so this will have to be a rapid fire. First of all, your view whether this will direct volumes to BSE and whether this is a long-term positive for BSE.
So it depends actually if the circular is a little silent on what SEBI considers to be the benchmark index.
A bit of a...
Then for any
let's just Rajesh, sorry, apologies if you can hear me. The line's a bit patchy. We're just going to come back to you in a few seconds as soon as we are able to fix that line. We've got the pre-open and just 5 minutes to go, actually, counting down to the market opening. And it's down 344 points. So we are basically going to start 50 points below the 20-day on the Nifty. It'd be interesting. The Bank Nifty, I think, also perhaps below the 20-day as well. The 20-day for the Nifty Bank is 52,540. And we're going to start at about 52,300 or so. Actually, it's a culmination of things altogether, from Tuesday close. Middle East, the F&O norms, not exactly positive cues from corporate earnings previews as well, especially Dabur, which is a bit of a shocker. We should actually have the Dabur stock as well.
Down
Take a look at
6.5% now. So
Yeah.
that's a nasty cut. Actually, even on the large cap screen, the fall is all over. L&T, Reliance, you name it. Bank Nifty is anyway down 1%. A lot of auto stocks are continuing to cool off. That was a trend we saw in the earlier part of the week. Bajaj Auto, Tata Motors, many of these stocks negative. ONGC, for obvious reasons, is the one green tick that we're getting right now. Let me watch out for Oil India. Yeah, likewise. So it's a very obvious trade. The beneficiaries with this bounce, tactical bounce maybe in oil prices. So these are the little green spots that we have.
Okay. Rajesh, we'll have you back later for a longer chat. But just a quick word on BSE. You were saying. Rajesh, go on if you can hear me.
Yeah. It depends what SEBI considers a benchmark index. Now, if NSE is allowed to retain the Bank Nifty as a weekly contract...
They're allowed to retain. They're allowed to retain, Rajesh. They can, if they choose to.
Then my suggestion to the NSE would be to retain the Bank Nifty as a weekly contract and move the Nifty to the monthlies. I think that would mitigate some of the losses we are talking about in terms of volumes for the NSE. Because clearly the day trading and market making and the weekly of the Bank Nifty is far more lucrative, both for the trader's point of view as well as the NSE's point of view. If that were to happen, then I think the losses can be contained at 15 to 20%. But if they decide to retain the Nifty, then I'm afraid, we're looking at a 30-40% drawdown for the NSE in its earnings.
But I mean, if this is so stark and clear, then they would go with the Nifty Bank, right, Rajesh?
I mean, it just depends on what the thinking of the board of directors of NSE would be, because the Nifty is like a globally quoted index. The Bank Nifty is more of a regional sectoral index. It just depends on what they think should be their flagship contract. Although I think the Nifties and the monthlies has always been there, and it has done reasonably well throughout its life of 20 plus years. The Bank Nifty was a relatively newer contract because of the volatility. It attracted the weeklies a lot more than the Nifty. So if they were to play only going by revenue, then I think they should choose the Bank Nifty. If there are other considerations, then I don't know.
Rajesh, you mentioned 15 to 20% loss. I mean, you were talking about the hit to NSE. Can you just repeat that point? This is going to be a drop in revenue, 15 to 20%?
Yeah, it'll be a drop in revenue for sure, to the extent of 15 to 20%, provided they keep Bank Nifty as a weekly. If they move to Nifty as a weekly, I'm looking at 35 to 40%.
Okay, all right. Anything else which stood out to you? It's largely in line with what they said they'd do.
It's largely in line with what they said they will do. One factor that might even affect the markets even more is the intraday monitoring of positions. Do remember, these position limits came into being in 2020 as a response to COVID. It was pegged at 500 crores now. With everything else, SEBI has said that the market has moved 3x since then. I think the limits ought to be revised 3x if we go by that same logic. And if it's kept at 500 crores, then I'm afraid it will be quite stifling for brokers to manage that on an intraday basis.
I think they are. Rajesh, thank you for joining us. I think they are going to be revised. The way that those are calculated, perhaps, will come up for reconsideration. We got the market open. It's a 1% cut straight up. 0.8%, 25,590 is where the Nifty is at. So it's not as bad as what the GIFT Nifty or the pre-open was indicating. It's 200 down though. The Nifty Bank is down about 1%, 52,400 on the Bank Nifty. You've got the sensex, which is down about 700, 83,560. The IT services index is once again down about 0.6. A complete flip-flop. Friday down sharply. Monday down sharply. Tuesday up sharply, and today it's down sharply once again. Look at the heat map on the Nifty. It's largely all down. Just about 5 names on the Nifty up in the green, everything else starting down in the red. So we are starting, I think there was a bit of a swoon to the 20-day, but now we are above the 20-day moving average, which is about 25,500 or so. That's the 25,505 is the 20-day moving average. So we're trading above it for now. The Nifty Bank, 52,400. That is about 100 points below the 20-day on the Nifty Bank so far.
Yeah, so the day's low, just to revisit that level, was 25,451. From there, there's a decent sort of a recovery, but it's really moving all over the place right now. Let's talk about where the weakness is. The worst of it is seen in the auto names, Eicher Motors, M&M, and this is despite Eicher coming out with good numbers, by the way. Even Hero's numbers didn't look that bad, the monthly sales numbers, but the market's dealing with very different sort of sentiment at this point in time. Big cuts on M&M, Eicher, even Tata Consumer, Asian Paints, these stocks have not been spared. Obviously, there's a crude corollary impact as well on the stocks like Asian Paints. Tata Consumer is down, Lever is also down, Nestle. So if you thought FMCG could be a bit of a safe haven, it's not turning out to be that way, at least right now. Then you have the big boys, ICICI Bank, L&T, Reliance. They're not helping the Nifty's cause, at least as of now at all. All of these stocks are down over 1%. The only thing that's working is commodities to some extent. So metals are being bought. The dips on metals are being bought. Nigel mentioned the point on steel as well. So JSW Steel 2.5% up. There's some buying on Tata Steel as well. ONGC, like we pointed out in the pre-open, with the flare in oil, people are gravitating towards ONGC. Not so much on Oil India. Oil India is actually starting quite negative, down 1.5%. Speaking of the oil-related plays, let's pull up BPCL, IOCL, HPCL. Down about 2-3%. But remember, the narrative has shifted very, very dramatically on oil marketing companies. And we'll get to that with our guest a little later. From talking about a windfall gain because oil prices crashed in September to now talking about geopolitics and a revival in oil prices. It's really moving all over for the likes of IOC and BPCL.
Well, that's right. Bazaar style, that's a stock that's actually flying away in today's trading session. So I think they had put out an update out there. And, that stock, in fact, is up and about in today's trading session. Bazaar style retail, I think that's the new listing out there. So that one's higher. Suzlon, that's seen some profit taking. It's down close to around 3% as we speak. Geo Financial as well is a little bit lower. These are some of the top volume movers. You have Tata Motors as well, that's down close to around 2%. And big boy Reliance Industries. We've been making this point that it was underperforming a little bit. But as we speak, well, that stock as well, it's down below that 2,900 odd mark. That needs to be the swing factor, needs to find its form from a bullish perspective. So that's about that. One crucial point though, on the Nifty as well as the Nifty Bank, we started below the 20 DMA, but as we speak, both those two averages now, indices have moved above the averages. So that's good news as well. So just keep an eye out on that. And BSE Limited, clearly with these regulations that have come about, they stand to gain more than NSE. So after opening up with a cut of around 1.5%, the street is now penciling in that market share will start moving to BSE, and they are better placed in comparison to NSE. So explains why the stock is quickly up 4% from the low point of the day. Marico as well has started in the red. That's done a U-turn. That stock is up close to around 2% odd. So we're down, but I don't think we're out as of now. 20 DMA by the end of today. The bulls will like to see a close around that mark.
No, absolutely, and we'll see how it goes. But, what we were discussing earlier, right? BSC, that's now up 4%. Although I think the debate will continue, right? I mean, there is a lot of thinking what NSE will do. I mean, will NSE do something to, can it protect its share of the market on the option side? There is, of course, this thing between Nifty, Bank Nifty. Rajesh Baheti telling us that the hit will be much lesser if they choose the Nifty Bank. And they're allowed to do it. So that we'll see if that is the thing. But can they do something else? There was some talk whether, they can introduce fortnightly options. Well, guess what? It's not allowed. Only weeklies and monthlies. There was some talk that maybe they can stagger, the monthly expiries on various products, right? But all of this will need to go back to the regulator, and they will need to come back and say, well, this is okay, that is not okay. So we'll have to see. And of course, I mean, the response of what BSE will do will determine how much share of the market and BSE you can gain. So for now, it's up about 4% higher at this stage. What else? You've got Angel One, which is the number one volume-led loser right now, but the cut is not much. Beg your pardon, it's Dabur. Dabur with a 5% cut is the number one volume-led loser. Number two is Angel One with a 2% cut. Varun Beverages is down about 2%. Hindus HPCL is down 4%. As Surbhi was saying earlier, IOC and BP perhaps should also be there. Nuvama is down 3%. So these wealth managers, right? That's the other one. So 6,300 on Nuvama. Edelweiss Limited is down about 4.5%, but it's seen a very sharp rally recently. KEC is down about 2.75%. 361, which is another wealth management firm, is down about 4% or so. There is Medi Assist, which is down about 3% or so as well. So there is a fair bit happening as far as overall markets are concerned. Market sort of advanced decline, a slam dunk in favor of declines. So about 1,800, 1,900 stocks are down and about 400 stocks are higher at this point in time.
You know, I was just looking at BSE, Prashant. It's remarkable the way the market's now buying into it. And BSE, by the way, through all the volatility and all the chatter, is practically at the 52-week high. So I guess the whole expectation and hope that ultimately whatever happens, whatever contract the NSE chooses, from 4 they're down to 1. So that should kind of limit their gains and, you know, be good for BSE in the longer term, right?
Incrementally, it is positive. I mean, think about it like this, right? I mean, most people do something every day on the NSE, right? Now, if they do something every day on the BSE, I mean, there is a bit of a network effect, right? You will start doing something in the cash side, you will start doing something somewhere else. So it's essentially familiarity and doing something on one exchange, which was NSE so far. And will that change habitually to the BSE? That's the question, which we don't have answers to, but I think...
But in terms of, I think, product offerings for the first time in I don't know how long, it's pretty much like a level playing field now because you can't do more than one product per week, right?
Yeah, absolutely. And, you know, we'll have to track this one, probably invite the exchanges over as well and ask them, right? I mean, how they view this, if they want to really talk, and we're trying that. But for now, it's about 2.25% higher on the day for a BSE. Yogesh Patil is with us, Chief Investment Officer Equity at LIC Mutual Fund. Yogesh, good to have you with us here. Thank you very much. Market's down 200. And of course, from the all-time highs, this is a pullback underway, but still a lot of debate whether this is a quick one or there is more here. Would you be a buyer here, Yogesh, or would you let markets consolidate, go sideways, some time correction? What's the sense?
Good morning, everyone. It's a lot depend on the valuations basically and earning growth. Today there will be temporary setbacks and like in past, but again fundamental will continue to drive the stock specific and sector specific approach. Till now, I completely agree. We reached a valuation point where earning need to perform here, and either earning growth or outlook on earning growth. Because what drives the broader market is basically liquidity, valuations, and earning growth. So valuations have reached the optimal level, liquidity is there, but today earning growth is lagging. So it's a completely sector-specific approach. Maybe we can ignore short-term even global issues, which is temporary in nature. But again, coming to your point, when we make an investment decision, is completely based on so many parameters that includes your interest rates and economic environment and growth available in the sector, basically. If you ask me, today, considering the bond valuation, equity valuations are actually fairly valued. The only thing drive from here is earning growth. If you get earning growth, then only you get a returns from here. So everything is depend on earning growth and sector outlook from here.
Hi Yogesh, good morning. Good to see you in. So what kind of earnings growth are you penciling in? Most on the street are in mid-teens for the next few years. Do you think that we'll get that?
Yeah, for Nifty, we are expecting roughly double-digit earning growth. But if you see the higher earning growth, we are expecting mid and small cap, where the most of the industry leaders are there. And the kind of capex we see, especially in power, data center, railways, defense, oil and gas, where 90% of our leaders are only available in small and mid cap. So we see higher earning growth in small cap because of the capex drive, and there are a lot of changes happen globally. And because of China plus one supply diversification, Indian companies are getting much more business traction, and their addressable market has increased compared to last 5 years. So because of this traction, the earning growth could be higher and more traction could be in small and mid cap compared to large caps.
Yogesh, I wanted to ask you about these capital market plays. That's been where the big party has been, right? You've seen the only listed exchange, BSE. Even in the unlisted market, you have NSE that's done very, very well. Brokerage firms have done well. Depositories have done well. What's your view currently? Because the equity cult in India will continue to grow from here on. Though some of these stocks have run a little bit ahead of themselves in terms of valuations. Your take?
I completely agree. But we need to also understand this segment is growing, right? And one should not only look the historical valuations or growth rate of sector. Look at the demat accounts, look at the mutual fund SIPs, and look at the awareness nowadays. It's very much. In fact, if you ask me, considering the F&O volume as a percentage of the cash market, we are actually much more matured now. The only thing is regular, we need to set some discipline. So this sector will continue to grow. And most of the investors should look for long term rather than a trader mindset. And there could be a, again, lull period or maybe negative period for some time. But structurally, India is heading for a good growth in economy as well as fundamentally, and that will reflect in capital market and participants.
So you'll continue to be bullish on this theme then?
Yeah.
Okay. And which segment, Yogesh, are you? Do you have exposure to without naming names?
Sorry, can't explain. It is a combination of direct, indirect exchanges and broking houses.
Broking houses, got it. No, fair enough. You know, Yogesh, we got numbers. You would have now seen numbers from Dabur, right? It's a bit of a shocker. So what's your view on FMCG? I mean, do you think even two-wheeler sales? I mean, the auto sales for the last month, which came through, it showed a bit of a spike, but looks like there was a fair bit of channel stuffing ahead of the festive season. Actually, if you look at the last, say, 6-7 months, the difference between retail sales and wholesale sales, it's actually quite wide, which means that there is a lot of inventory now in the system. So the next couple of months, perhaps sales numbers drop off. The local market, the India market, not exports. So just your overall view on consumers out there.
Yeah, you're absolutely right in terms of inventory. But again, for let's take automobiles, especially Q2 and Q3, because of a lot of changes in festival dates, we should look exactly quarter versus quarter. But I completely agree what's happening, and we need to monitor next 15-20 days. But we should keep a quarterly approach, and especially on FMCG side, we do see some improvement in rural and urban consumption based on so many factors that includes your favorable monsoon, government measures, and increasing wage rates. So last 4 quarters was not very good, and today inflation is coming back, and again growth in rurals or rural wages also coming up. So we expect some positivity in consumer business, including discretionary and non-discretionary. And at the same time, automobiles, we need to again monitor for 15-20 days would be very crucial for this sector. And we should only take a decision based on quarter, not on month, because month on month is keep changing based on monsoon, based on festivals.
Okay. Yogesh, finally, what is your take on the oil and gas space? Because there's so much going around, oil marketing companies or even upstream companies like ONGC. I mean, how do you take exposure to the energy space, and what's the stance on it? Do you like it at all?
Yeah, definitely. We cannot ignore this space. But again, we would be positive on basically retail companies or maybe gas company compared to a crude company. Because we do, our internal assessment is there would be a oversupply in gas and crude oil for next after maybe 1 or 2 years. So India could be beneficiary, both are we are importing, and that's why we are more positive on distribution side and retailing side here rather than basically core commodity like crude oil and gas.
All right, Yogesh, thanks a lot for joining in and filling us in with your take on the markets. Wishing you a good day ahead. Well, let's move on. Let's connect with the management of NLC India. India's new national electricity plan aims to meet the peak demand of around 458 gigawatt by 2032. So what are the opportunities lined up for the power and the renewable companies? How is business momentum shaping up? To discuss this and more, we're joined by Mr. Prasanna Kumar Motupalli, the Chairman and Managing Director of the company. Hi, sir. Good morning. Always good to see you, Ben. Tell us with regard to this new electricity plan that's been laid out. What kind of opportunities does it throw up for a company like yours?
Yes, this new electricity plan that is 2020 to 32, that is envisaging demand increase of almost 7 to 8% up to 2031-32, and then subsequently 5.76% for the next years. And in all the 3 areas, there is a certainly encouraging initiatives are there in thermal power generation, overall power generation, transmission and distribution. in thermal capacity addition compared to current capacity of 4.59 lakh megawatt capacity. It is expected that the total capacity will reach to almost 9 lakh gigawatt by 2032. So, and in the transmission system also, many transmission corridors are coming for evacuation of the renewable power. Both these things are giving an opportunity to our company. As we are into mining, we are into thermal power generation, also we are into the renewables. So in line with the National Electricity Plan, we are also targeting huge capacity addition. As on date, our company is 6 gigawatt company. We are targeting to become a 20 gigawatt company by 2030 and around 22 gigawatt by 2032. So in line with
Sir, just if I could interject, please, to get more clarity on this target of 20 gigawatts by FY30. How much is going to be traditional thermal and how much is it going to be by renewables? What is the plan on the generation side and on the renewable side in particular?
Madam, as on date, our total capacity is 6 gigawatt. Out of that, 1.4 gigawatt is renewables. So we are at 24% of renewable capacity as on date. So by 2030, we are targeting to become 20 gigawatt company, 10 gigawatt conventional capacity and 10 gigawatt renewable capacity. So our proportion of renewables will be more than 50% by 2030. That is our target capacity addition.
Okay, that's quite interesting. And also just to get the math right, I mean, between generation and the main business, which is mining, lignite and coal, what is going to be the mix again by, let's say, 2030, since power generation is growing in a big way for you?
Yes, madam. In line, along with the power capacity addition, we are targeting for increasing our mining capacity also almost that double. As on date, we are around 50 million metric ton company, 30 million metric ton lignite and 20 million metric ton coal. This we want to take to 100 million metric ton by 2030. And all actions for reaching this 100 million metric tons are on. Recently, we got the Machakata coal mine, which is having huge reserves of 1.4 billion and 30 million metric ton capacity. So along with the power generation and renewable capacity addition, we are targeting to increase our mining capacity to almost double the current capacity.
So, sir, you know, the reason I ask you this, because if we look at some of the brokerages on the street and the ones that are quite optimistic on NLC India, one such broker says that over the course of the next 2 to 3 years, FY24 all the way up to FY27, they are expecting you to do a top-line growth of 15% across businesses, blended top-line growth of 15%, and an EBITDA CAGR of 20%, and also PAT also growing at 20%. So 50% top line, 20% at EBITDA, and 20% profits for the next 2-3 years. Is this possible? Is it a reasonable expectation to have?
Yes, madam. That is a reasonable expectation. We are also targeting more than that. So our top line, our EBITDA, and our PAT all will increase at a good rate till 2030-32.
Rate, sir, you said you will do better than what some of these brokers are saying. What is the target you are setting for the company? The growth rate?
Madam, we are not setting any target for the top line or this thing. We are targeting mainly the capacity addition aggressively in both conventional as well as renewable capacity. And we are also increasing our mining capacity. So we expect returns more than 16% and increase at the CAGR of around 15%.
Okay, all right. Sir, for a company like yours, regulated equity is very important, right? So could you tell us what it is right now and how do you see it moving up? A brokerage note is suggesting that you can move to around 19,000 crore by the end of this decade. Your take?
Yes, as you rightly said, ours is mainly in regulated business. And as on date, we are having regulated equity of around 7,800 crores. Where in the mining sector, we get return of 14% post-tax, and in thermal power generation, 15.5% post-tax. So going forward, we are targeting to increase this share to 23,000 crores by 2030. So in next 1 year period, this will be increased by around 4,000 crores. we will reach around 11,000 crores regulated equity in 1 year, because our Ghatampur thermal power station as well as our Pachwara South coal block, both are will be operational, and that regulated equity gets added to our regulated equity. So in 1 year it will be increasing to 11,000 crores and 23,000 crores by 2030. That is our target.
No, in 1 year, when you say, sir, it will touch 11,000 crores and Ghatampur will come on stream, that's this year, FY25 by March?
Yes, FY25 March or by the first half of the next financial year. The entire capacity will be added.
Okay, so 11,000 crores, let's say by first half of FY26 would be the sort of the fair assumption. Got it. Sir, just to talk about more about the here and now, we've spoken a lot about the FY30 targets. Our colleague tells us that, there were some issues in terms of land acquisition for some of the mines at Navili. So could you tell us what the status is over there and what is the recovery in the business that you will envisage? By when do these issues go away?
Madam, in the year 23-24, first half of the financial year, we faced problems because of the land acquisition. There were some communication gap, and because of that, some land acquisition issues were there. And our thermal power generation, lignite production, both were getting affected. But in the middle, by December of last financial year, we completely addressed all these issues. Whatever the problems were there, there was one river which was required to be diverted. We diverted that river, and subsequently we have taken around 560 hectares of land into our possession. So from January 2024 onwards, our lignite production as well as the generation are at peak, and there is no generation loss on account of lignite shortage. So all the issues of land acquisitions are sorted out, and we expect that there will not be any problem because of land acquisition and subsequently lignite generation and power production.
Okay, all right. Very quickly, before we let you go, sir, you have given us a broader timeline, targets. Coal production for this year, I think you were targeting around 16 million tons, and I think lignite was at around 24 million tons. Both those two are on course?
Yes. Last year we produced all-time highest ever coal and lignite, that is 36 million metric ton. This time, as you rightly said, we are targeting 16 million metric ton of coal and around 25 million metric ton of lignite, and we are on course, and the production is happening in line with our targets.
All right, and very quickly, that IPO, last time around you had briefly hinted that the IPO could be due of the renewable portfolio. By Q4 of this year, markets are quite buoyant and they like this story. You think you'll come to the market with that offer?
Exactly. As on date, the process of transfer of our renewable shares to our newly formed subsidiary, NIRL, is in progress. And we are expecting that to be completed by the end of this calendar year. So we expect that in the last quarter of this financial year or the first quarter of the next financial year, this IPO will come.
Navily Renewables IPO could come either in Q4 of FY25 or first quarter of FY26, right?
Exactly.
Okay, so we'll have NTPC Renewables and Navily Renewables. It is the era of green energy. Got it, sir. Thank you so much for joining in, and good to get that perspective as well. Really appreciate it. Thanks so much. So there's so much changing, right? So much underway that traditionally what we're seen as dirty businesses, coal mining, lignite mining, thermal power generation, they're all trying to change and look at the energy transition. Speaking of energy, that is the big global headline as well, right? As we start our next conversation, let's actually pull up crude oil prices. Last I checked, there was a minor sort of 0.5% kind of a move that was still visible. So basically, the Middle East situation has taken Brent at least back towards 75. That's where we are at this point in time. Now, what does this mean for the entire oil and gas complex here in India? We have Mr. M.K. Surana with us, as well as I think Prabal is also with us, Prabal Sen joining in to give us some perspective. Mr. Surana, thanks very much for joining in, and Prabal, good to have you on. If I could actually start with Prabal, because we were looking at some very different numbers till I think Monday. Prabal, the word on the street was the kind of windfall gain that oil marketing companies are sitting on because oil prices crashed in September, right? I think I saw an ICRA note saying that on the marketing side, maybe they're looking at a 15% boost in profitability. Now, where were you on that debate in terms of the cushion that OMCs had? And now we are in a very uncertain territory. So what happens now?
No, I think both the things I think have to be looked in perspective. At the time that the marketing was making remarkably strong profits, which is most of September, once the crude prices, sort of reversed to somewhere around $70 to $72 levels. At the same time, refining margins have obviously seen a steep downturn. So, if you look at Singapore margins, they have been pretty much flattish at somewhere between $2 to $2.50 a barrel. And that means that, on an integrated level, while margins are certainly strong, but, typically, if I look at consensus and our estimates, integrated margins, say for HPCL, those estimates are basically around 6.5 rupees a litre. Those numbers are still, prevalent at more than 7.5 rupees. So to that extent, it was obviously still a comfortable situation. Right now, what was the fear earlier was that there could be a price cut in terms of retail fuel prices, and to what extent can the OMCs absorb it? Our sense was earlier at about $70, $71, a 3 to 4 rupee price increase could have been easily absorbed without impacting earnings below, what the street was already factoring in. Now, of course, crude, at this level, let me absolutely clarify that crude is still at a very comfortable level. The reaction that you see is more around the fear of what happens if this conflict escalates and crude prices basically go on a one-way tear back to $80, $85 levels. At this point of time, I think margins, earnings at $75 are not a concern at all.
Not a concern. Got it. So just for clarity, up till Monday, what is the kind of fuel price cut you would have perhaps penciled in and the companies could have digested as well, given the comfort on the marketing margin side? And now, are you completely ruling out the possibility of any cut at the pump?
No, I am not. I don't have the foresight or the capability to rule out anything. All I can say is that till let's say a couple of days ago, I think anything around 3 to 4 rupees should have been comfortable, because the marketing margins on retail fuels, as per our calculations, were close to about 10 to 11 rupees, and they needed margins to be at 5 to 6 rupees to offset the fact that GRMs are basically about $3 lower than what they would have been in a normalized environment. Now, again, I think they will probably take a call, and Surana sir is there, so I won't want to say too much on how the thought process works, but they will probably look at this situation for a while before taking a decision.
All right. Gentlemen, morning. Prashant here. Mr. Surana, good to see you back on the channel after a while. Appreciate you joining us. So, this price cut, whether it'll be a price cut or... I was thinking maybe price cut, I don't know, but excise hike, maybe yes. Because the logic would have been if you cut prices, maybe states will undo that by increasing VAT, etc. I don't know. If you can comment on this, I think Prabal also wants you to. So what's the sense? What should we expect?
Okay, so I think Prabal and you had made already a broader commentary, and that's very much true in the sense that what was the situation, let's say 3 days back, is different today when the crude price again jumped up because of the some sort of tension in the Middle East. And I had been telling always that people tend to take a one-sided view that whenever there is a fall in the crude price, we should cut the price. But when it is going up, probably there is a clamor against that the prices are too high. But we cannot have the one-sided view, and actually we need to account for both. So when the prices were high, the prices were not increased. So when there are prices, we have to absorb the under recovery which are there earlier. And therefore, I think we should be appreciating that fact that when the crude prices goes down, there will be a period when the prices cannot be reduced. Now, there are two issues that we need to see the marketing companies or OMCs as an integrated margin, which includes the refinery margin, which includes the marketing margin. And as Prabal has said, and you are all maybe aware, the marketing, the refinery margins are quite low right now. It is in the $2.5. And the crude prices are increasing. And we also need to factor in the inventory gains and losses which will happen, especially considering that the prices are increasing after 1st October. And the prices have fallen down before 30th September. So the last quarter may have the impact of the inventory variations also. So if you ask me personally, as of today, I think even though there may be a lot of clamor for reducing the prices. I think we need to watch for some time to see that how the crude prices move, considering the tension which is developing. And second thing is that also considering the future elections, the possibility of increasing, if it is reduced, will be limited. The third part is that the taxation part, you have rightly mentioned that if the central government reduces the taxes and the state government increase the taxes, the customer is not getting a benefit of it. And it is only a transfer of the revenues from, let's say, central level to the state level without any benefit to the consumer. But in the whole process, the pressure remains on oil companies. So I would say that it's a time to watch before we take a call on reducing the prices.
Okay, all right. Hi, Mr. Surana. Good morning. Good to see you. Well, how do OMCs manage their inventory, their raw material supplies basically, in times of issues in West Asia? Crude prices have now surged. Does it impact supplies immediately?
So the question is, it is not that what you need the crude today, you're ordering today. So at least a month back, that would have been booked. And normally there are different terms depending on the payment, whether it is 30 days, whether it is on the leading date, or what it is, M+1 month, N-1 month, depending on the risk management policies which the company will have, or it may be a mix of all this, and also whether the companies are hedging. So what will be the impact in terms of the ultimate impact on the companies in terms of the price variation, that depends on a combination of it, in addition to the base pricing of the crude.
I wanted your comment on this rights issue for IOC, Mr. Surana. That's been withdrawn. The government is not putting money in OMC as promised. Your view?
I think IOC should be okay with it, because when in the oil companies are able to generate the money even from the debt market in a much comfortable way. So why should there be need of getting the money through the equity market as of today? That was, if it is not going to the P&L, if it is going to the balance sheet side, I don't think that it makes sense. So I think IOC should be okay not getting it now.
Okay, very, very quickly, Prabal, since we have you with us, what's the advice at a stock level, considering this is going all over the place? And as you mentioned rightly, I mean, refining margins are also under pressure. Oil and gas, at least with the next 6 to 12 month perspective, what stocks to be in and which ones to avoid?
No, I think we continue to sort of be structurally positive on HPCL. That view hasn't really changed. Specifically with respect to FY25, it's almost, as you rightly mentioned, it's very, very difficult to pin our earnings number down at this point of time. And the vulnerability or perceived vulnerability to marketing obviously makes it a tough call at this point of time, given the uncertainty in retail margins and crude prices. Having said that, two things that one needs to keep in mind. One, consensus earnings, which, for standalone HPCL, if you look at them today, they were already factoring in fairly low retail margins as well as subdued GRMs. So the chances of earnings down are limited at this point of time unless there is an outsized price cut, number one. Secondly, the business mix that is changing for HPCL for the next 2 to 3 years in favor of refining, if one looks at the expansions that are going on, as well as the petchem capacity that they're adding, should actually improve the businesses because the marketing dependence is going to continue to reduce. Leverage, I think, will probably continue to reduce over the next 2 to 3 years because their capex cycle is almost getting over, unlike some of their other larger peers. So to that extent, and valuations continue to remain comfortable, we would probably remain a buyer at this point of time. Having said that, the risk reward seems weighed in favor of risk for the next 6 months. That is something investors need to keep in mind.
All right. Gentlemen, we'll leave it there. Mr. Surana, great to have you back and hope we can do more of this. Appreciate you joining in. Prabal, thank you very much, as always, for running us through what you make of the situation in your stocks. HPCL, sort of structural overweight for Prabal. We'll take a break here. Markets down 170, but look at the BSE stock, which is flying. And that's the name we were discussing pre-open as well. There was that indecision. It started lower, then it was about 0.5%, 1% in the green. It's up a full 7% now, 275, 276 rupees on BSE Limited at this point in time. We'll take a quick commercial break here. We'll come back. We have Ben Powell of BlackRock Investment Institute joining in on Global Markets. Stay with us. Okay, welcome back. We have Ben Powell now joining us, Chief Investment Strategist for APAC at BlackRock Investment Institute. Ben, good to have you with us here. Thank you very much for your time. You know, let's talk about what's top of mind. Global markets have largely ignored all the fighting around the world, right? And there's a lot of fighting going on. There's Russia, Ukraine, there's stuff in the Middle East, but markets have made new all-time highs. Oil markets have been largely unaffected by all of it. Do you think, we had a one-day large reaction in oil and wicks, etc. in the US because of the Iran missiles. But do you think markets will fade these moves very quickly? Or do you think this is little different, especially with regards to Iran and Israel? So far, the conflict looked a little coordinated, right? I mean, there'll be some attacks and the other side will attack, provide an out, some face saving for the other side. So there was some element of coordination. This seems a bit uncoordinated, if I can use that word. So could spiral. Your thoughts, Ben?
Hi, Prashant. Yeah, great to be with you. I think, unfortunately, the market is getting used to this kind of event. We've entered a much more volatile environment geopolitically over the last several years. Perhaps that's really a consequence of moving into a more multipolar world, US-China tensions and all of that. And kind of under the hood, what we're seeing is historical fault lines, pre-existing fault lines are coming back to the surface, Russia, Ukraine, Middle East and elsewhere. So sadly, I think this is likely to continue in the years ahead, and we're going to have to deal with more and more of these episodes. What that means, though, as I mentioned, is the market is becoming kind of more efficient at discounting these relatively quickly and looking through them to focus on some of the other obviously very important drivers, be that Fed cutting, be that China stimulating. And for now, of course, the human situation is tragic, but from a market perspective, the market seems to be much more focused on top-line growth globally and by different economies, falling interest rates, and that combination continues to be rather positive for risk for the moment.
Ben, hi. Good morning. Great to have you on. You actually just preempted my next question because the word I was going to ask you about was complacent. Are markets getting more complacent, ignoring a lot of risks, being at elevated levels? But you said, no, they're actually getting more efficient. So from here on, what would be the key triggers to track? Because your view is quite positive on US equities overall, right?
Yeah, we're pretty constructive. So for the moment, of course, as investors, we're always nervous and anxious about everything. But for the moment, we'd be more nervous about being underinvested than being overinvested. So we'd still be risk constructive, let's say, in the US in particular. Of course, we have this artificial intelligence mega force, as we call it at BlackRock, the world's largest investor. And this is really continuing and actually broadening out. So we've seen a lot of the excitement so far quite reasonably has been centered around the foundational technology, the chip makers, the web services, and that's totally fine. But what we think should happen now is a broadening out of some of the excitement into more of the ecosystem, the architecture around the AI. So things like utilities, energy, materials, because for now, AI is still a technology you can stub your toe on. It still exists in the physical world, and it needs, in particular, an energy architecture to kind of feed it the calories to think it's great thoughts. So we are nuancing our AI excitement a little bit and focusing more on that broader ecosystem, critically including energy, rather than just being focused on the big seven, magnificent, no doubt, though they have been.
All right. Hi, Ben. Good morning and good to see you, Ben. This is Nigel on this side. You like the US markets, but what about an emerging market like India? As you've highlighted in your note, demographics are in our favor. Working population will be moving up. We have got earnings growth as well. But at current valuations, is that a bit of a headwind?
I think, look, there's a lot to like in India, as you guys are extremely aware. So the combination of demographic plus productivity gains, digital inclusion, infrastructure, and so forth. I think the big picture in India continues to look very, very favorable, but always there's nuance. I actually think the short-term issue is nothing really to do with India. It actually could be the gravitational pull of China. So China, as we're all aware, India has become recently, a few weeks ago, became the biggest constituent in MSCI emerging markets, taking the crown from China. And that's great, right? We've all enjoyed that. But I do think if China is going to follow through on its stimulus promises, which we may see as soon as next week, it's quite likely that some of the money that global investors have put to work outside of China, be that in other emerging markets or other parts of Asia, probably gets pulled back into China. So I think there might be a little bit of a headwind, really nothing to do with India, but to do with global capital flows moving back into the world's second largest economy as they put their foot on the gas. So maybe a short-term kind of a challenge, again, no fault of India, but to do with China. So a short-term headwind caused by this, but again, from a bigger picture perspective, a lot to like in terms of growth dynamics, reform, and inflation context, which is radically different to where we were just a few years ago. So a lot to like.
Ben, just two questions, and if just want brief answers on these. Running out of time. One is, do you think if you look at over a period of time, when you get when China gets money, emerging market funds get money. History shows that all emerging markets get money. So is it this or that? If funds go into China, does India will it be negative for flows into India? That is one. And second, just to go back to the geopolitics, if over the next, say, 24, 48 hours, oil infrastructure within Iran is hit, do you think it will cause ripples and asset markets around the world will react? Go on.
So on the first of these, I think it's both. If I can have my cake and eat it too, I think it is both this and that. So I think in the very short term, you might see a few buying of China funded by not China. So I think that can be a slight headwind briefly. But your broader point is the right one, which is overall, and this is why we at BlackRock are overweight emerging markets strategically, this backdrop of Fed cutting and China stimulating normally is pretty encouraging for emerging market risk writ large. So I think, yes, if the big one, I guess, China within the emerging market framework goes from really being flat on its back, right? Sentiment, positioning, and more broadly, thinking towards China has been extremely negative for the last many quarters. If that perks up, I think you're absolutely right. It should be encouraging for the broader asset class, including India, as an important part of emerging markets. On the second of your question, yeah, look, I mean, for the moment, it looks like this is a relatively, of course, we shouldn't underestimate the human element, that's for sure. But from a market perspective, I think the market is considering this to be something as unfortunately, a normal part of the mood music in the backdrop. Of course, we are all watching the escalation cycle with both eyes. And if it looks like it is starting to spiral and move to a totally different level where perhaps other powers are getting involved, then of course we would need to reassess. So let's see. It isn't that for now. If that changes, we will adjust accordingly.
All right, Ben, we'll leave it there. Good conversation. Thank you very much for joining us, and hope we are able to do this more often. Thank you. And good to have you with us here on CNBC-TV18. Well, I think we'll take a quick commercial break here. We're going to come back with, let's just do one thing. Let's go across to Mitesh, who's with us. By the way, before I go to Mitesh, BSE is up 8%. That's the number one volume-led gainer by far. So with the, it was... we were discussing this pre-open, that maybe BSE does benefit, to what degree, etc., would have to be seen. But it started 0.5%, 1% higher. From there, it's moved up a full 8%. And even something like an Angel One. Look at Angel One. It's the second largest volume-led gainer, and it's a complete U-turn. So it started sharply lower. The day's low on Angel One is 24.50, and the stock's now at 2,700. So that's the kind of turn we've seen here on Angel. Mitesh is with us. Mitesh, your thoughts on markets, your trades, and a quick view on BSE and Angel One. Go on.
So, Prashant, on the market, we were talking about 25, 450, 500 zone. We've got a low over there and managed about 100-point kind of a pullback. Just watching and hoping that this level holds. And if that does happen, then I think we might see a few days of choppy consolidation before again turning on the upside. The worry would be only if we start breaking below today's low, which is 25,450, and then we might get into a short-term corrective mode. This still being classified as a pullback. Having said that, I think Angel One is something which I like a lot. In fact, it appears to have done a good correction from highs of 3,800 plus to about lows of 2,000, and then now is reversing on the short to medium term charts. As long as it's about 2580, I think this stock has the potential to go to a target of 3050 to begin with, and in a good case scenario, 3400 as well. So very positive setup over there. BSC I'll avoid. I don't have a very clear view. I think it's been doing very well, so it's just a good stock. But the levels and all, I think I'll hold my horses for the time being. And on my trades, JSW Steel is something. Jindal Steel is something which I would want to recommend as a short-term trading bet on the upside. Buy here with a stop at about 1,030. Look for targets of 1,120. And Jubilant Foods is on the negative side, so a sell with a stop at 652 and a target of 615.
Mitesh, you really read my mind as you were talking about Angel One. Just before that, I was looking at a one-year price chart, right? In the market, it's all about pricing things in. And that one-year chart tells the story of why today Angel is not, reacting adversely at all. Because from 3,800 falling down to, I think, about 2,100, the stock priced on a lot of the regulatory headwinds, including flat fee structure, when that was rolled out, the anticipation of these tighter F&O norms. Perhaps all of it got factored in as the stock cooled off from 3,800. And we've seen a lot of accumulation actually at lower levels in the last few weeks. That's Angel One. We'll take a very quick break, come back on the other side. Yeah, that's what I was talking about. So it's been correcting for the past many months in anticipation of these tighter norms. Now they're here. It's all done and dusted. And you move ahead. And perhaps the market still believes that overall the business growth will continue. Let's take a break on that note. We'll come back with more stocks and more news on the other side.
Welcome back. Well, some select steel names continue to do well. In Morgan Stanley, they have come out with a note. So let's address that first. They believe that the Chinese recent stimulus will drive positive sentiment and also support prices. They're saying that they're seeing lower risk of imports, and that should support spreads in the near term. The other factor that they're highlighting is there are various green shoots that are visible for the spreads in the near term at least. An important part on pricing, they're saying now the domestic prices are at par with imported steel. Earlier, it was at a discount. It was a premium. Imported steel was at a discount in comparison to domestic steel. So the fear was that since Indian steel is trading at a premium, there could be a correction. But now they're highlighting that it's pretty much evened out. So that risk in terms of price cuts, that goes away. Because of all of this, they've gone ahead. They've raised their estimates in terms of pricing as well as in terms of spreads for all these companies. And they've done a U-turn on a lot of companies. For JSPL, they've upgraded the stock. Target prices moved from 970 all the way to around 1,200. JSW Steel as well, they've upgraded the stock from 895. Now the target price moves to 1,150. And on Tata Steel, they now upgraded it to an equal weight. The target price from 135, it's moved to around 175. And on SAIL, they still maintain the underweight stance, but they've increased the target price from around 105 to around 125. So that's about Morgan Stanley. Nomura, they've initiated coverage on two stocks. That's on JSW Steel as well as JSPL. Buy rating on both of them with the respective target prices coming up for you on the screen. The few reasons that they are citing: strong domestic demand, continued deleveraging will support Indian steel majors from now on. The cost drivers, that's what will keep cost under check and in turn improve profitability. And also they have highlighted that Chinese HRC prices, well, they have hit drop. And now from here on, they're expecting a recovery. Though they have highlighted some risk as well, they said the downside risk could be weak in domestic demand, some monetary tightening as well as expansion delays. So explains why a couple of those names are doing quite well. JSPL and JSW Steel, both of them outperforming because of this note coming in from Nomura. Just one more stock, guys, I want to highlight is ITD Cementation. In the last 30 minutes, suddenly the stock has gone up close to around 15%. The promoter entity had come out there and said they want to find a buyer. The street believes maybe that they're closer to finding that buyer as well. 15% higher on that name.
Maybe announcement around the corner. The last, of course, bit was that the Adani Group, was perhaps was leading the race to buy the promoter stake of ITD Cementation. So we will see. We had the management of KEC, who was one of the other sort of players rumored to be in the race, and we asked them, and but they sort of refused to comment whether they're still in the race or they are out. Stocks sharply up about 621 or so. Markets down about 250. It's kind of strange, right? I mean, markets taken a bit more of a dip, but broader markets are doing better. You know, lots and lots of names up 3, 4, 5% with volumes as well. I'll mention a few others in a bit. But Bazaar is what we're going to focus our energies back on. Stocks down sharply after the sort of earnings, the pre-earnings report. Mangalam is here with more. Mangalam.
Well, Bazaar has reported a dampener in their second quarter update. The consolidated revenue for the company has actually declined in mid-single digits, and that's largely on account of two factors. One, because of unseasonal or heavy rains and flooding in some parts of the country, out-of-home consumption was impacted, and as a result of which their beverage portfolio saw a bit of a hit. But the bigger reason was they are rationalizing their inventory in general trade, and that's largely because of the big growth that we've seen in e-commerce and quick commerce in particular, and as a result of which their primary sales are down. That's something that the street is a little worried about. And because of this decline in primary sales and continued spending on marketing and advertising, the operating margins of the company too have come down from their guided 20% to mid-teens to high teens sort of number. And that's exactly what has the street worried. Remember, the stock had corrected about 10% from its highs already going into the second quarter update. But at the start of the year, the company had guided for double-digit revenue growth for the entire year as well. And in light of that, this decline of mid-single digits is something that the brokerages aren't very happy about either. Marico, on the other hand, doing extremely well in today's trading session for three reasons. One, consolidated sales have grown at high single digits with mid-single digit sort of volume growth. But importantly, the stock had underperformed because of Bangladesh tensions. And now there, the company said in the second quarter, Bangladesh business has actually shown high single digit revenue growth, telling you about the resilience of the business in that country despite internal troubles in Bangladesh itself. The margins of the company have seen a bit of a lag this time around, so that's one important trend to monitor going forward. But they reiterate double-digit revenue growth in the second half of this year and the full year as well, and that's something that is sitting well with the street.
Okay, all right. Thanks very much for that, Mangalam. Bazaar definitely reeling under that impact. And with that, we actually have to take a very quick break. When we come back, it'll be time for our special segment. It's the economy. Actually, today it is full-blown Indianomics. Lata will be in conversation with a host of guests to discuss how the ongoing geopolitical tensions and macro developments in China impact the Indian market.